Hello, this is Brandon Rogers and Trent Bradshaw with Bradshaw Financial Planning and Mind Your Money. Today we're going to talk about a topic of understanding the stock market. So these are a number of topics that we put on throughout the year, and really this is just some feedback from the clients that we work with and just people in the general public that just want to learn more about some things out there and how this world works, right? So, today we're going to talk about understanding the stock market, and it should be a pretty good dive into this high level, but we'll get into the weeds a little bit too. So let's go ahead and get started with that. When we take a look at this first slide, when it talks about when to start investing. Basically with this, the sooner somebody starts, the better. You really want to have time on your side when it comes to the market because it goes all over the place, right? So some of the three golden rules that we look at is invest early. Obviously, again, earlier the better. Invest regularly, and we'll talk about potentially doing dollar cost averaging later. And then invest for the long term, not the short term. Obviously, the market can be very emotional in the short term, and so this really can also just be looked at a longer term time frame.
And obviously, you're touching on up markets and down markets throughout any period.
Yeah.
Just consistently investing over time.
Consistently investing, that's right. That's kind of the key to it, and try to keep emotion out of it, which I know is definitely hard to do sometimes.
It's difficult. It's difficult.
Yeah.
Well, let's talk about where to invest. There's many places that you can, consider an investment of some type, but we'll touch on a couple items here. You can look at physical assets like real estate, gold. Sometimes we hold gold in the portfolios, commodities, etc. When you're looking at commodities, you're talking about agricultural products from that standpoint. Also, financial assets such as fixed deposits, could be CDs, could be money market. Just as simple as checking and savings. In addition to that, small savings instruments, insurance products, could be cash value life insurance. You look at your pension funds that are available. Some folks have a pension from the place that they're employed at now or have been employed. Many don't, though, at this point, so there's been a change in that arena. But also securities related to the market, be it stocks and bonds. Probably the easiest way to invest, the quickest way and most liquid way to invest in the long term.
We're taking a look at just what Trent said, talked about short and long term options for investments. Here we got some examples of some short term vehicles, basically. So savings and bank account, obviously there's going to be really limited, no downside risk. FDIC insurance, obviously anything that's held at a bank directly. You got money market or liquid funds, fixed deposits with banks. So again, mainly the key word here is liquid. Meaning you can get your hands on it pretty quickly. So that's very key for the short term. Maybe this is where you have your emergency fund, right? So you don't worry about risking the assets because you might need to get your hands on it. Longer term, here's where we get into your market instruments. We've got your stocks, you got your ETFs or exchange traded funds. You got individual bonds. There's bond ETFs. There's bond mutual funds. Mutual funds, all different types of assets can be held in that. And we'll take a closer look at what a mutual fund is and how it's structured.
Well, why trade in the stock market? Well, you don't need to know a tremendous amount of information on how to own stocks throughout the market in general. There's several different ways. Brandon just touched on many, with it being mutual funds, stocks, etc. But the market's more liquid than buying real estate. Normally, you'll carry a mortgage if you buy a rental property, and of course, there's debt against that. Whereas if you buy a stock, you own that piece of that company in certificate form. It requires very minimal time to trade, unlike building a conventional business. There's a lot of business planning that goes into that. Obviously, a lot of people make the most return on businesses that they own. But if you want to purchase something that's liquid, the stocks or exchange traded funds are a good way to go. It's fast. Basically, you can convert it from a stock to cash in a very timely manner.
When you also look at the types of investors that you've got out there, obviously there's different views on the market. People have different opinions, right? But I would say, the vast majority of people would be long-term investors, which again, that's, just saving again throughout as early, like we said, early as possible throughout your working age. And then also, through retirement. Your savings shouldn't stop then, just because you may have some, needs in that time as well. So, long-term, like say 5 to 7 year time frame, again, we got a longer period of time. Speculators, they're really going to be short term. They're going to be getting in and out, and we'll look at an example of potential day traders from that end. And then we got hedgers, basically hedging. A number of ways, different ways you can do that within the market, but an easy way to kind of look at it is look at fixed income as a way to kind of lower your risk. You're just hedging because when the stock market does go down, which we always know it will, these positions will kind of provide some type of hedge or some type of protection so you don't feel it as bad when that happens.
Well, types of trading that you can get involved in. Obviously, there's day trading. With the advent of online trading, brokerage firms that allow low cost to even zero cost as far as ticket charges when you buy and sell a stock. Day trading can be a part of what you do, but again, in the long term, you want to be that buy and hold investor where you buy the stocks, buy the exchange traded funds, or buy the mutual funds for the long term. Again, day trading, you might have a set price that you go in, purchase something at a certain price. When it hits your target price, you're actually selling, and you can do that in a number of days, even in the same day too. But for the majority of 95 to 98% of the investors out there, we're looking at the buy and hold.
Yeah, buy and hold. I mean, day trading carries just a whole bunch of risk, and usually you only hear the one side of the story of a day trader potentially doing really good.
Exactly.
I don't really talk about the downside. So day trading can be fun, but and okay to do for a very small portion of your funds because it's obviously very risky.
Sure.
From that end.
Yeah.
Let's talk about some of the different things between what a public company is and what a private company is, and some of the differences. Obviously, when you're looking at the private companies, they're companies that you can't really go out on an exchange and buy stock into, right? They're going to be privately held. Kind of a good example of this was potentially like Dell Computers. So Dell used to be privately held, then it went public and issued stock, and then it went back and went private again.
Right.
So some companies do that, right? It just kind of depends on where the owner or the board wants to go with that. Stocks are basically going to be part of publicly traded companies, okay? So they represent a small portion of actual ownership of that company. So you actually have an ownership. You can vote. They're going to have voting shares in regards to that. Everybody can probably get these proxy mails and materials in the mail to say, hey, we want to vote our annual conference. Some people do it, some people don't, but you definitely have the right, and that's why you get it. When you issue stock, companies that want to go from privately held to publicly held, they have to issue stock, and that's a really kind of drawn out process, and we'll kind of touch on that on a high level. But it's basically how a company can issue shares of its stock and then trade on the open market.
Well, how stocks are issued. Let's look at this. There's three different ways or three different items we want to take a look at. Well, stocks are issued through an IPO, initial public offering. When they come onto the market, they normally go on as a common stock. That common stock you just mentioned, most of the times you'll have voting rights in regards to the company. You'll get proxies in the mail to where you have a right to vote on the decision of the board of directors, etc. from that standpoint. But also there's preferred stock. Preferred stock's a hybrid between a common stock or actually owning the stock of the company, and then also owning a debt instrument. That debt instrument will have some type of yield tied to it. It could be 3%, it could be 6%, it could be 7%. A variety of different ways that a preferred stock can be structured. In addition to that, we always hear a lot about stock splits. All right, everybody gets excited about when a stock splits from 100 down to 50 because they're going to double the amount of shares that they own. But what you've got to understand is it doesn't really open the door of where you're going to have more money in that stock, and it doesn't necessarily mean that stock's going to go up. Most companies will split their stock to make it more liquid to the retail investor so they can buy more shares. We have a lot of stocks now that are valued at $1,000 or more in the public marketplace, and it's hard to buy 100 shares of a $1,000 stock. In some cases, impossible for a lot of people. So that's why companies split their stock and make it more available. As you'll see on the side of the slide here, well, it says shares are representation of ownership. And again, that's your common stock ownership. Stock certificates are rarely printed anymore. That's a good point because a lot of people will request to get their stock certificates. Now it costs $75 anywhere to $125 to physically have those printed. Right now it's better just to hold them inside the brokerage or hold them at the transfer agent.
Yeah, the stock splits, like I say, you don't see them happening really that much anymore. Just kind of the way the market's evolved. You can buy fractional shares, things of that nature. So you've got a lot more, I guess, availability out there. And then with certificates, maybe a lot of people like to buy a share Disney for the kids and have an actual certificate. I mean, it's great and all. It's really, really, really cool art, basically, that comes with some of those certificates. But companies really prefer you to hold them electronically now. It's also kind of better for you too, because you're able to keep those electronically and sell them, pretty easily. Otherwise, it's kind of a drawn-out process if you have a paper certificate.
It becomes cumbersome, no doubt about it.
So when we talk about matching buyers to sellers, okay, so this is actually how a stock actually trades, right? So just remember, every time if we go out there and we sell the stock or you sell the stock, there's always somebody on the other side of that transaction that wants to buy it. And vice versa. If we're buying, somebody wants to sell. Those are conflicting views, right? Somebody thinks it's going to go up, so they want to buy it. Somebody thinks it's going to go down, so they want to sell it. This actually runs off a factor of what they call bid and ask, right? So, when you look at bid is where someone wants to purchase a stock. Ask is where someone wants to sell it. Market makers are kind of in the middle, matching up these buyers and sellers, and the price in between is really the market itself. So that's actually how a stock trades. It's actually pretty interesting. What are some of the things you look at as far as a spread, though, between that bid-ask?
Well, when you look at the bid-ask, basically it's a function of liquidity. What that means is how easy it is to get in or buy a stock and how easy it is to sell a stock. Mm-hmm. And when Brandon and I are looking at certain exchange-traded funds or individual stocks, we're looking at that spread because it tells us how liquid it is to get in and out. Mm-hmm. So it's definitely something we focus on and basically helps us make some decisions on whether it's a good entry point or not.
Yeah, you definitely want to make sure you can get in and out of it pretty easily. That's pretty key for sure. A couple of different things that we'll look at now. Obviously, everybody's heard the terms of a bull and a bear market, right? So, this is kind of looks at the differences between the two. Basically a bear market is typically when the market's down for a longer period of time. This is where kind of recessions pop up and you look at it. Recession basically talks about 2 back-to-back quarters of declining GDP or gross domestic product for just the U.S. Say that obviously, for example, that's the one we're probably all always looking at since we live here. But bear markets are usually a 20% fall from recent highs. If you kind of look down there at the bottom, it has a pretty good stat there. It says the average bear market lasts about 1.3 years with an average loss of about negative 36%. Again, everybody remembers those times, but it is painful during that time for sure. When we look at bull markets, obviously that's when we are looking at rising markets. Everything's going pretty good. You kind of see that stat there for the bull market of lasting about 6.6 years with an average return of 339%. So, when you look at it just in general, the market's up more than it is down. And these are looking at a pretty wide range that we're looking at. We're looking from 1926 down to the March 31st of 2020. So a pretty good range of time frame we're taking a look there. But bear and bull, yep.
But basically, on the statistics, 70% of the time the market goes up, 30% of the time the market goes down. And you can go all the way back to the 1920s, and that statistic hasn't changed.
Right.
It's been pretty consistent.
Yeah.
As far as portfolios, in developing portfolios, we look at really 3 different arenas when we're looking at equity type positions. Equity being stocks, which represents ownership in a company. You've got your mutual funds. Mutual funds are managed accounts that trade only once a day at 4 o'clock at the close of the market. It's a basket of stocks. On average, you'll hold about 150 stocks within a mutual fund, so you have a tremendous amount of diversification. Mm-hmm. Exchange traded funds, they're not really that old. They're pretty new to the industry. Mm-hmm. And if you look at it, an exchange traded fund, the advantages over a mutual fund is it's more liquid. You can trade those between 9:30 in the morning to 4 o'clock in the afternoon when the market closes. The exchange traded funds also have more sector-based or focused type approaches compared to most mutual funds. But there's advantages and disadvantages in each arena here, and it's definitely something that we would consider. Mm-hmm. Most of the time in a diversified portfolio, you're going to be more exposed to your mutual funds and your exchange traded funds. And then one of the best ways to invest over time in these particular products is called dollar cost averaging, and you'll see it at the bottom of the slide. Dollar cost averaging usually occurs through 401ks, IRAs, even individual accounts. And what it means is, regardless of what the market is doing, you're investing a set amount or targeted amount of money over time, and you're trying to take a lot of the volatility out of the market, the ups and downs, trying to take that out and smooth that line out. And ultimately, what we're trying to do is make it a consistent environment where you're putting money in over time, and then in the long run, statistically, we know you'll come out ahead.
Yeah, and again, when we're looking at in individual stocks, everybody's got. I mean, you carry some risk in there,
Sure.
right? All stocks have different risks, but it's kind of way to kind of try to limit some of that risk is spreading it out through the mutual funds and ETFs, because all they are is just a basket of stocks of individual companies that you hold. So a mutual fund or ETF could hold hundreds of different companies. So that's a good way to kind of spread your risk out. We're looking at possibly long positions. Again, this is just when you say a long buy. This is when you buy a stock or you buy a fund or you buy an ETF or whatever it may be because you're thinking it will rise in the future. Again, statistically it's on your side from that end, but when you're long a position, that means you think it's going to go up, depending on what your time frame is, it short term or longer term, but still you think it's going to go up from that end. Future indexes, so that's going to be where you can buy or sell financial indexes at a set price, settle on a future date. This is more where commodities trade, right? So you'll see, wheat, orange juice, things of that nature that will trade at future time frames, and that's a futures index. So that's very interesting to watch, and we'll talk about some exchanges where that's
and it can get into equity options too in regards to hedging a portfolio and. In addition, taking additional risk. If you expect the market to go up, using these future contracts can actually leverage on the upside. Sometimes it's not the smartest thing to do.
Yeah.
But on the other side of the equation, it can provide some protection. You can use it for some of the hedging techniques that Brandon was mentioning earlier.
Yeah. And then lastly here, we got dividends. Obviously, everybody knows about dividends and heard a lot about them, but a true dividend kind of investor is not really too concerned about the stock price because those dividend stocks can certainly go up and down, but they're looking at them for consistently trying to pay out some income from an individual company. So those companies will state what their dividend per share. So whatever share amount that you have, that's the amount of dividend you get per share. And that can go pretty consistently. The price doesn't really go off price movement up and down. It goes off the number of shares. So therefore, that's why I say it's not too concerned about where the price is, the stock is. You're not really a growth type investor. You're more of an income. So you just want some type of steady flow of income. Stock portfolio can still go down with dividend paying stocks. That's a key to remember, but it's just kind of a different mindset.
Yeah, we got to be careful because sometimes investors focus just on the dividend and think if a company's paying a high dividend that it's a great investment over the long term. But what you've got to understand is the dividend sometimes, if it's too high, can be a signal for me and Brandon that may be a red flag, that we need to evaluate the company more.
There are these types of companies, and it's broken down through a couple different levels, and we'll talk about that. And it's looking at the total value of the company's shares, right? So it tells you how big a company is. Obviously, you got your first ones. It's going to be mega cap companies. So this is 200 billion or plus. All right. So obviously, these are pretty regular household names. You got your Apple, Verizon, Walmart are going to be your mega cap companies. Large cap are going to be between 10 billion and 200. Tractor Supply, Exxon, Netflix. So again, still obviously well-known names. Mid-cap type companies, 2 billion to 10 billion. We're going to look at the kind of the Rolls-Royce brand, Papa John's, and Yeti. Still pretty much recognizable from there. And then you look at your small cap companies that are publicly traded that are 300 million to 2 billion. Bed Bath & Beyond, Sonic, and Smith & Wesson being an example of that. So, this is kind of where you're looking at. Obviously, your large kind of blue chip type stocks are really going to be U.S.-based large cap and mega cap positions for the most part. And then we can, obviously kind of sprinkle in mid cap and small cap companies throughout just to have a well-diversified approach. But that's just kind of a definition of what some of these are.
Well, one thing we could add to the mega cap section is when you get to that level, it's really not just a U.S.-based company now. They're selling their products globally. So there's a lot of advantages with the mega cap arena. Not that we're recommending one over the other, but just keep that in mind. Exchanges. The exchanges that we're looking at most of the time is the New York Stock Exchange, And the Nasdaq, that's where we'll find the majority of individual stocks. Even the exchange traded funds and mutual funds that we invest into utilize these indexes to purchase their particular positions within their portfolio. The New York Stock Exchange, normally you'll see a ticker symbol. Ticker symbol is just going to be a representation of the stock itself. When you buy a stock, you will enter through a ticker symbol. New York Stock Exchange, anywhere from 1 letter to 3 letters. Normally with Nasdaq, you'll see anywhere from, well, most of the time, 4 letters in regards to designation of the companies there. And of course, we'll see some examples of those coming up. Then you've got the CME, which is the Chicago Mercantile Exchange, and also the Chicago Board of Options Exchange. When you look at that, that's for your option contracts that you can purchase. And again, we really don't get into that an awful lot, but it's a way to utilize, set up hedges, and also use leverage if and when a client asks about those particular things. But again, ticker symbol is very important. When you're looking to purchase a stock, you got to know what the ticker symbol is. And of course, Brandon and I can assist you with that.
And also when you're looking at how a stock trades, or how we talked about earlier where a stock gets issued, they issue the stock and they choose to whether do they want to list their stock on the New York Stock Exchange, which is, again, it's a little higher cost and a little more prestigious kind of out there. Or you look at the Nasdaq, which is usually a little bit lower cost and more technology-based companies go there. Yeah, it's pretty interesting with the ticker symbols as far as, again, how those are structured. Usually the single letter ticker symbols are really sought after for companies, and that's a pretty interesting concept. And then when you look at mutual funds, most mutual funds all kind of end with an X as well. So that's just something out there that you might see from time to time.
Here's a good example of some of the companies that would be listed on the Dow Jones Industrial Average. When you look at the overall breakdown here, some of these companies may have been acquired by others. In addition to that, they're going to be your mega cap type companies where you've got the 200 billion evaluation or more. And you'll see some of these that you recognize: Apple, Visa, Boeing, Coca-Cola.
Yeah, and again, I always talk about, like, when you go home and turn your TV on at night, this is what you hear about: the Dow and the S&P and the Nasdaq, right? So, the Dow is really one of the older indexes that was created, and it's usually about 30 industrial stocks, and U.S. based, right? Can have products globally, but based here in the U.S. So, a lot of people really follow the Dow and you hear about it on the news a lot, but it really only represents about 30 different companies. So we can kind of transition over to the next one when we look at the S&P 500.
Right.
Now, this is obviously a much broader list of companies, and again, you'll see some here on the screen of logos that you can definitely recall seeing. But again, this is a broader mix of stocks, U.S. stocks, so they're going to be a lot more so far than just the Dow 30.
Well, normally in the S&P, you're going to have around 500 stocks. Now, that can change. One can acquire another, and it will drop. Like currently, it's like 498. But again, it's about 500 companies within this index, very well diversified, owns 11 different asset classes across the board, and it's really the benchmark that everybody takes a look at. It's actually a better benchmark than what the Dow Jones is, because the Dow only owns 30 stocks.
Then we look at the Nasdaq. Again, we covered that just a second ago, of it also being the exchange. Again, a lot of these are going to be majority of them will be kind of your technology companies that you'll see. But
well, small and mid-cap companies too. The smaller and mid-sized companies will be on the Nasdaq most of the time.
Yeah. So been another good example of a really diversified approach. So again, we just want to kind of cover those. What are these terms everybody's been hearing? The Nasdaq, the Dow, the S&P 500. So that's really what these are. It's just, again, handfuls of baskets of stocks. Okay.
This slide goes into some of the technicals and also the fundamental data that we take a look at when we evaluate a stock. You'll see earnings per share, and you'll hear that all the time. But basically what that is the net income that a company earns divided by the number of outstanding shares. And earnings per share is important because we're obviously looking for positive earnings per share when we evaluate a stock. And or if it doesn't have positive earnings now, we're looking at the growth rates, which drops toward the bottom of the page here. We'll talk about that one in a minute. But then we got the price to earnings ratio. Well, the price to earnings ratio is a good metric. If you look at it, the S&P 500 average over the long run is about a 16 price to earnings ratio. So when you're buying a stock, an easy way to evaluate that stock is to go to the PE ratio. If that PE ratio is 16 or lower, potentially you're able to buy that stock at a value area at that point. If it's higher than 16, then hey, it may be expensive compared to the overall market, but we'll need to take a look at it. But really, how you get the price to earnings ratio, you take the current market value per share of the stock, and you divide it by the earnings per share, and that gives you your PE ratio. And again, it's a good metric to use. The last one is price to earnings to growth, which is called a PEG ratio. Anything less than 2 is considered a value. Well, how do you calculate the PEG ratio? It's called a PEG. Well, you take the price divided by earnings per share divided by the earnings per share growth rate. If you do that and you get a factor less than 2, then again, normally it's seen as being a value in comparison to the market averages.
Yeah.
Right?
Yeah. So these are good technical indicators to kind of look at, and again, how some individuals take a look at what company to buy.
And there's so many technical data points that we can look at. In addition to that, there's a ton of fundamental information. Again, this rolls into some of that fundamental data. But you can get, I guess the information can overwhelm you at some given points. Yeah. So you've got to take, and really these 3 are the ones you probably want to focus in to make it a lot easier for you to understand.
Yeah. Sounds good. Well, that's what we wanted to cover today. Hopefully that clears up a lot of some questions that people have. Obviously, we'll continue to have these educational classes. Send us any more ideas that you may have, or again, we do these things for you. So just keep us posted on what you want to hear about, and we can see if we can put something together.
Sure.
But obviously, reach out to us with any questions. Join us on social media and our YouTube channel as well. Great way for us to communicate and provide some of these educational resources to you. But I'm Brandon Rogers and Trent Bradshaw with Mind Your Money.